The phenomenon of Wall Street is not merely a geographical location. It is the epicenter of global financial power, a place where billions of dollars are earned and lost in a matter of hours, and the fates of individuals, corporations, and even entire economies can shift in the blink of an eye. It is an arena where speed of thought, precision of analysis, and uncompromising decisiveness determine success or failure. Today, we will delve into the very essence of this phenomenon, exploring the most remarkable single-day profit explosions in the history of financial markets. These events are far more than just impressive figures. They are windows into the strategies, psychology, and market contexts that allowed specific individuals or funds to achieve colossal profits. Our ambitious goal is not only to unveil these astonishing sums amassed by financial geniuses, but also to meticulously examine the strategies behind these successes, the profound market context that made them possible, and the crucial lessons that these events hold for every trader and investor aspiring to understand and master the dynamics of the market. What precisely do we mean by the term single-day profit explosion? This concept extends beyond the ordinary definition of significant profit accumulated over a prolonged investment period. We are discussing a rapid, dramatic, and often unexpected surge in capital that occurred as a result of active and highly targeted trading or a strategic bet that materialized within an extraordinarily short time frame, often within a single intense trading day, or a series of pivotal days when the market reached a turning point and profits grew exponentially. Such events, as we shall see, are exceptionally rare, a fact underscored by statistics. Less than 1% of day traders are successful in the long term. This stark reality only emphasizes the uniqueness and mastery of those who manage to execute such financial maneuvers, transforming market volatility into personal triumph. It is crucial to clearly differentiate these phenomena from the general growth in market capitalization of entire companies, which occurs when a company's stock value increases due to overall economic growth or successful corporate operations. Our focus is on the profits generated by specific individuals, hedge funds, or investment firms through active trading operations that demanded not only profound analysis, but also extraordinary courage, impeccable execution, and often the ability to act contrary to prevailing market sentiments. These stories are not just narratives about astronomical sums of money. They are tales of exceptional intuition, deep analytical insight, psychological resilience, and the capacity to identify opportunities where others perceive only chaos or insurmountable risk. They demonstrate how individual prowess can indeed alter the course of financial events. In 1992, the world witnessed one of the most monumental and dramatic financial maneuvers in history when the legendary investor George Soros orchestrated an unprecedented speculative attack against the British pound sterling. This event, famously known as Black Wednesday, yielded his hedge fund, Quantum Fund, an astounding profit exceeding $1 billion in a single day, solidifying Soros's reputation as one of the most influential financiers of modern times. The market context leading up to this event was extremely tense and complex. At that time, the United Kingdom was a member of the European Exchange Rate Mechanism, ERM, which mandated that the pound be maintained within a specific narrow band relative to other European currencies, particularly the German mark. However, the British economy was under immense pressure. The country was grappling with high inflation, and its interest rates were significantly higher than those in Germany, creating a substantial burden on businesses and consumers. The Bank of England's policy of supporting the pound appeared increasingly unsustainable and costly, as they were compelled to expend billions on interventions to prop up the currency's value. Soros, relying on profound macroeconomic analysis and a deep understanding of fundamental economic imbalances, concluded that the pound sterling was artificially overvalued and inevitably destined for devaluation. His strategy involved establishing a massive short position against the pound. This meant his fund borrowed pounds sterling in colossal volumes, estimated at up to $10 billion, and immediately sold them on the foreign exchange market at the then high rate. The objective was to buy back these pounds at a significantly lower price after the anticipated devaluation, with the difference constituting his profit. Soros's in-depth analysis was predicated on the unwavering conviction that the British government could not long sustain an artificially inflated pound exchange rate without inflicting severe damage on its own economy and political stability. He was not merely speculating on a random event. He was betting on fundamental economic laws and the inevitability of market forces. His actions, which included massive sales of the pound, essentially accelerated the inevitable, intensifying the pressure on the Bank of England. Ultimately, on September 16, 1992, the Bank of England was forced to withdraw from the ERM and devalue the pound, leading to a sharp decline in its value. This decisive move earned Soros the moniker, the man who broke the Bank of England, and stands as a vivid illustration of how a deep understanding of macroeconomics, combined with astute intuition and uncompromising resolve, can lead to colossal profits. This historical episode underscores the importance of independent thinking, the ability to perceive what others are unwilling or unable to see, often due to political or economic constraints, and the readiness to act decisively when market conditions validate one's analysis. It also demonstrates how even the largest central banks can be overcome by coordinated actions of major speculators if their fundamental position is inherently unstable. Our next case transports us to the period immediately preceding the global financial crisis of 2008, when the name John Paulson became synonymous with one of the most successful and prescient bets in history. A monumental wager against the subprime mortgage market, while the primary profit, amounting to $4 billion personally for Paulson and $15 billion for his fund, Paulson and Company, was accumulated throughout 2007. The sheer speed at which these profits materialized during the market's collapse created a distinct explosion effect in key days as the housing market plummeted and other investors faced catastrophic losses. The market context at the time was permeated by euphoria and blind optimism. The U.S. housing market had been experiencing a frantic boom for many years, and the vast majority of investors, analysts, and even rating agencies were convinced that home prices would never fall. A widespread belief persisted that a house is always a good investment. However, beneath this facade of optimism lay immense and systemic risks associated with low-quality, subprime mortgage loans, which were being extended to borrowers without adequate verification of their ability to repay. These loans were then bundled into complex securities, such as mortgage-backed securities, MBS, and collateralized debt obligations, CDOS, which astonishingly received high ratings from agencies that either failed to comprehend or chose to ignore their true risk profile. Paulson's strategy was extraordinarily complex yet brilliant in its simplicity and effectiveness. He recognized that the securities backed by subprime mortgages were a ticking time bomb. To profit from their inevitable collapse, he utilized credit default swaps, CDS. Simply put, a CDS is a form of insurance against the default of a debt instrument. Paulson purchased CDS on these mortgage-backed securities, essentially betting that these instruments would lose value and their issuers would default. When the mortgage market began to unravel, and borrowers increasingly defaulted on their loans, the value of these CDS contracts skyrocketed, generating astronomical profits for his fund. Paulson's profound analysis lay in his contrarian approach, directly opposing the prevailing market optimism. He didn't merely perceive superficial risks, he delved into the core of the problem, meticulously analyzing the structure of mortgage pools, the quality of the underlying loans, and the flawed mathematical models used to evaluate them. He understood that the entire system was built on a foundation of sand, and that a collapse was inevitable. His engineering of complex financial instruments to profit from this downturn required not only deep knowledge of financial markets and derivatives, but also extraordinary courage, unwavering conviction in his judgment, and immense fortitude. For an extended period, he swam against the current, and his investors harbored doubts about his strategy, as the premiums for the CDS were substantial, and had the market not collapsed, he would have incurred enormous losses. This narrative vividly confirms that the highest profits are often reaped by those capable of discerning hidden risks and acting contrary to widely accepted views, all while possessing ironclad patience and robust justification. Moving on to one of the most legendary traders, whose name has become synonymous with mastery in risk management and precise forecasting, Paul Tudor Jones. In 1987, he accomplished what seemed impossible. He accurately predicted and profited immensely during the stock market crash of October 19, 1987, an event infamously known as Black Monday. Through his astute strategies, he amassed $100 million during what was one of the fastest and deepest market collapses in history. The market context was a classic illustration of an overheated economy and a speculative bubble. The U.S. stock market had been soaring for many years, reaching new historical highs. There were elevated levels of margin debt, where investors purchased stocks with borrowed funds, creating additional speculative pressure and rendering the market extremely vulnerable. Sentiments were euphoric, and few experts anticipated such a sharp and sudden collapse. Many believed that the market would continue its upward trajectory indefinitely. Jones's strategy was multifaceted and grounded in deep technical analysis and historical parallels. He meticulously studied price charts and market behavior, specifically drawing comparisons to the 1929 crash, noting similar patterns in price graphs and indicators. He employed sophisticated technical models and indicators to determine that the market was at a critical juncture. Jones did not merely wait. He acted decisively, taking significant short positions, effectively betting on a decline in prices. He was one of the few who dared to go against the pervasive optimism. Jones's profound analysis demonstrates mastery in discerning subtle technical signals and sensing market sentiment. He did not allow the general optimism to blind him. Instead, he focused on objective data and historical precedents. His ability to make quick and resolute decisions under extremely volatile conditions was absolutely crucial. He understood that the market was on the precipice and was prepared to act while others panicked or were paralyzed by fear. A vital aspect of his success was also his rigorous risk management. He didn't merely short the market. He did so with a clear plan, setting stop losses and carefully controlling the size of his positions, even though his bets were aggressive. This story serves as compelling evidence that the ability to read charts, feel the pulse of the market, and act with discipline can be as potent a tool as fundamental analysis, especially during periods of extreme volatility. He demonstrated how a catastrophe for the majority could be transformed into colossal success for a discerning few. In a world where financial markets are in a constant state of flux, and their history is replete with both triumphs and catastrophes, understanding the past becomes an invaluable asset for any investor or trader. For the lessons of history often repeat themselves, albeit in new guises. If you aspire to delve deeper into the evolution of Wall Street, from the initial panics that shook the nascent American economy, to the era of grand financial manipulations and the establishment of the modern exchange, then Henry Clews's 50 Years in Wall Street will prove to be your indispensable guide. These illustrated memoirs, presented in 2 volumes, span half a century of tumultuous history from the Panic of 1857, which marked one of the United States' first major financial crises, to the celebrated Gilded Age, an era of unrestrained economic growth and simultaneously vast inequality. Within the book, you will discover not merely dry chronological facts, but vivid, captivating accounts of the prominent financiers of that period, their strategies, risks, and incredible successes. It also meticulously details the intricate market manipulations that were prevalent in those times, illustrating how, even in the absence of modern regulations, the market operated under its own brutal rules. This is not merely a historical document. It is a journey through time that allows one to observe how the fundamental principles of the market, greed, fear, innovation, and cycles, remain constant, despite all external changes in technology and instruments. It offers a unique perspective on the psychology of market participants from bygone eras and will help you better comprehend the context of the events we discuss today. as well as develop your own critical thinking regarding contemporary market trends. This is an investment in your understanding of history that will, without a doubt, pay dividends many times over, providing you with a deeper insight into the timeless laws of finance. To broaden your horizons and enrich your knowledge of financial markets, be sure to find the link to 50 Years in Wall Street in the description of this video. This is an opportunity to tap into the wellsprings of financial wisdom. Following the profound financial crisis of 2008, when the global economy teetered on the brink of collapse and the banking sector was paralyzed by fear and distrust, David Tepper, the founder of Appaloosa Management, executed one of the boldest and, as it turned out, most profitable bets of his career. He made massive investments in the shares of major American banks, which were then at the epicenter of the crisis, and his fund, Appaloosa Management, earned a staggering $7 billion in 2009. This profit was the result of an extraordinarily rapid appreciation in the value of his assets after the market rebound, clearly highlighting the profit explosion effect. The market context was permeated by deep distrust, widespread panic, and pervasive uncertainty. The banking sector was widely considered toxic, its reputation shattered, and its future precarious. There were serious fears of nationalization, mass bankruptcies, and a complete breakdown of the financial system. Most investors in a state of panic fled from bank stocks, selling them for paltry sums, as no one wished to hold on to what appeared to be a falling knife. Tepper's strategy was a classic yet immensely risky contrarian approach. He held the conviction that the U.S. government would not permit major banks to fail, as such an event would trigger a complete and irreversible collapse of the entire financial system and the nation's economy. He anticipated that the government would undertake all necessary measures to stabilize the banking sector, even if it necessitated massive infusions of taxpayer funds. Tepper recognized that bank stocks such as those of Bank of America and Citigroup were catastrophically undervalued by a market engulfed in collective panic. He acquired these shares when they were trading at historical lows, understanding that their true intrinsic value was significantly higher than their market price, provided the government succeeded in stabilizing the situation. Tepper's profound analysis demonstrates not only his financial acumen, but also the psychology of a player against the crowd. He possessed a unique ability to discern value where others saw only boundless risk and potential bankruptcy. He understood the macroeconomic implications of government support, the Troubled Asset Relief Program, TARP, quantitative easing programs, and other stimulus measures. His decisions were based not merely on complex financial models and assessments of bank balance sheets, but also on a deep comprehension of political will and economic necessity. This was an example not just of courage, but of cold, calculated risk-taking that allowed him to capitalize on market panic. He understood that the fear gripping the market created unparalleled opportunities for those willing to take calculated risks with intelligence and a long-term vision. Tepper demonstrated that sometimes the most profitable investments are made during moments of greatest despair, when the majority has already capitulated. His story underscores the critical importance of a deep understanding of macroeconomic policy and its pervasive influence on markets. We conclude our list with a story that is one of the oldest, yet no less striking and instructive, the tale of Jesse Livermore, the legendary trader of the early 20th century. He became renowned for his uncanny ability to read the market, and crucially for the colossal profits he generated during the Great Crash of 1929. Livermore famously shorted the stock market both before and during this devastating collapse, which ultimately led to the Great Depression, and amassed an astounding $100 million. This sum was colossal for that era and, adjusted for inflation and purchasing power, equivalent to billions in contemporary money. The market context of the 1920s was an era famously known as the Roaring Twenties, a period of unrestrained economic growth, innovation, and, unfortunately, an unprecedented speculative boom in the stock market. Stocks were trading at inflated valuations, often with little to no connection to their true fundamental worth. Millions of ordinary Americans invested in stocks, frequently utilizing margin loans, believing that the growth would never cease, and that a new market had somehow repealed the old laws of economics. General euphoria and the illusion of easy wealth permeated society. Livermore's strategy was founded upon his profound understanding of market trends, cycles, and, most critically, crowd psychology. He was a master of technical analysis, albeit without modern computer-aided tools, relying instead on his own meticulous systems for tracking prices and volumes. He observed that the market, which had been rising for years, began to exhibit alarming signs of weakness. Trading volumes were increasing on price declines rather than advances, indicating growing selling pressure. Livermore began cautiously opening short positions, progressively increasing them as market behavior confirmed his theories. He did not rush, but he acted decisively when he saw validation of his hypotheses. Livermore's deep analysis lay in his unique ability to read the market and act resolutely, refusing to succumb to the general euphoria that engulfed everyone around him. He did not heed the experts who urged buying, nor did he yield to pressure when the market temporarily rallied, causing doubts about his strategy. His intuition, honed by years of experience and a disciplined approach to trading, was unparalleled. He understood that market cycles are recurrent and that after a boom, a bust inevitably follows, proportionate to the preceding expansion. His story is a classic example of how individual insight, the ability to think independently, and the courage to act against the crowd can triumph over collective blindness and lead to immense financial success. He was a master at identifying market turning points, and his trading principles remain remarkably relevant today. Having examined these 5 exceptional stories, which span nearly a century of financial markets and showcase a diversity of strategies, we can identify a number of common traits that unite these financial titans and their incredible profit explosions. Firstly, there is the unwavering contrarian approach. All of them possess the courage to go against prevailing market sentiments, often when the majority of investors were moving in an opposite, frequently euphoric or panicked direction. They were not afraid to stand alone in their convictions, even when their ideas seemed audacious or even irrational to most. This ability to think independently and perceive what is hidden from the eyes of the crowd is fundamental. Secondly, their decisions were consistently based on deep analysis, whether it was macroeconomic analysis, as with Soros, enabling him to foresee the pound's devaluation, or fundamental analysis, as with Paulson and Tepper, revealing undervalued assets or hidden risks, or masterful technical analysis, as with Jones and Livermore, identifying market turning points. These were not random occurrences or blind luck. These were meticulously planned, reasoned, and thoroughly tested bets, supported by hours of research and contemplation. Thirdly, these traders were characterized by conviction and patience. They were prepared to maintain their positions despite immense pressure, significant volatility, or temporary losses, because they deeply believed in their analysis. This demanded colossal psychological resilience to avoid succumbing to doubt or panic. Fourthly, despite generating enormous profits, these traders also assumed substantial risks. However, they did so calculatively, with a clear understanding of the potential consequences and, crucially, with effective risk management strategies in place. They did not simply bet everything. They managed their positions to maximize potential gains while simultaneously minimizing potential losses. And finally, speed of reaction and impeccable execution were critically important. The ability to respond swiftly to changing market conditions and to effectively implement their strategies, often amidst extreme volatility, distinguished them from many others. What lessons then can we draw for the present day, applying these principles to our own investing or trading endeavors? 1. Opportunities always exist. The market consistently offers opportunities for significant profits, but these demand not only diligent research and analysis, but also the courage to see what others overlook and to act accordingly. 2. Market psychology is key. The importance of understanding market psychology and its influence on prices cannot be overstated. Emotions, fear, greed, euphoria, panic, often drive markets more profoundly than logic and fundamental indicators. Successful traders learn to harness these emotions to their advantage rather than being swayed by them. 3. Continuous learning and adaptation. The financial landscape is in a perpetual state of flux. The necessity for continuous learning and the adaptation of trading and investment strategies is paramount for long-term success. What worked yesterday may not necessarily work today. 4. Discipline and emotional control. These are, arguably, the most critical aspects. Successful traders do not allow fear or greed to dictate their decisions. They adhere to their plan, set stop losses, lock in profits, and possess the humility to acknowledge and learn from mistakes. It is vital to reiterate that such profit explosions are exceptional occurrences, not the norm for the vast majority of traders. These stories are not an endorsement of reckless risk-taking or an illusion of easy riches. On the contrary, they exemplify a level of mastery, dedication, and intellectual rigor that is rare. However, these narratives serve as a powerful source of inspiration. They demonstrate that with deep analytical thinking, ironclad discipline, and a unique strategy tailored to your own style and risk tolerance, it is indeed possible to achieve extraordinary results. They encourage us to cultivate our intuition, think critically, and not shy away from going against the prevailing current if our analysis guides us toward the correct path. Each of us can glean valuable insights from these market masters. And if you wish to not merely learn about the history of financial geniuses, but also to immerse yourself in the psychology and strategies of one of the greatest traders of all time, Jesse Livermore, whose story concluded our top 5. Then the new edition of Reminiscences of a Stock Operator is an indispensable read for anyone serious about trading. This is not just a retelling of his memoirs, first published decades ago. It is a profound analysis of his psychology and strategies, enriched with contemporary commentary and analysis for each chapter. These supplementary materials transform his decades of experience into practical, applicable lessons for modern traders and investors. You will learn how he thought about the market, how he made decisions under conditions of extreme uncertainty, how he overcame setbacks, and how he achieved incredible successes, becoming one of the wealthiest individuals of his time through stock trading. This book serves as your personal mentor, teaching you to read the market, understand cycles, manage emotions, and develop your own trading philosophy, which is the key to long-term success. Do not miss this unique opportunity to convert Livermore's experiences into your own knowledge and skills. Find the link to the new edition of Reminiscences of a Stock Operator in the video description to embark on your own journey toward market mastery. Your financial future begins with learning from the very best.